Retirees across the United States need to pay very close attention right now because a banking activity that many people consider normal or harmless can lead to serious tax consequences, including penalties that can reach $10,000 or even more. This is not about rumors or fear. This is about how federal tax rules interact with everyday financial behavior, especially for seniors who receive Social Security, pensions, retirement distributions, and sometimes stimulus-related credits or other benefit payments. Recent enforcement patterns and ongoing federal reporting requirements mean that certain transactions, if misunderstood or handled incorrectly, can raise red flags. Today, this update will clearly explain what kind of bank activity can create problems, how it connects to IRS reporting rules, how it may affect retirees who receive Social Security, pension income, or other benefits, and what steps older adults can take to protect themselves from unnecessary penalties. Many retirees believe that once they stop working full-time, their tax situation becomes simple. They may assume that because they live on Social Security and perhaps a small pension or retirement account, there is little chance of facing major IRS penalties. However, the reality is that retirement often brings a different kind of complexity. Income can come from multiple sources, such as Social Security retirement benefits, supplemental security income for those who qualify, distributions from traditional IAS or 401k plans, survivor benefits, annuities, part-time consulting work, rental income, or even occasional asset sales. Each of these income streams interacts with federal tax rules in specific ways. At the same time, banks are required to report certain types of transactions to federal authorities, and those reports can lead to audits or penalties if the information does not match what appears on a tax return. One of the most misunderstood areas involves cash transactions and structured deposits. Under federal banking law, financial institutions must report cash transactions over certain thresholds. When a retiree deposits large amounts of cash into a bank account, especially repeatedly, that activity may be flagged for reporting. This does not automatically mean that something illegal has occurred. However, if the deposits do not match the income reported on a tax return, or if they appear to be intentionally broken into smaller amounts to avoid reporting thresholds, this can lead to serious scrutiny. The penalties connected to improper reporting or perceived structuring can be severe, and in some cases, civil penalties can reach $10,000 or more per violation. Many seniors are unaware that even innocent behavior can look suspicious under automated monitoring systems. For example, a retiree might sell a vehicle for cash, receive repayment of a personal loan in cash, or withdraw funds from a safe at home and then deposit them gradually. If those deposits are made in repeated amounts just under federal reporting thresholds, the pattern itself may trigger a report. This does not mean that retirees are doing anything wrong intentionally. However, if the IRS later determines that deposits represent unreported taxable income, penalties can be assessed. These penalties can include accuracy-related penalties, failure to file penalties, failure to pay penalties, and in more serious cases, penalties related to willful violations of reporting rules. In addition to cash deposit issues, retirees must understand the tax reporting requirements tied to retirement accounts. Once a person reaches the required age for mandatory withdrawals, known as required minimum distributions, failing to withdraw the correct amount can trigger a significant penalty. Although recent law changes have reduced some penalty percentages for missed required minimum distributions, the penalty can still be substantial if the mistake is not corrected quickly. If a retiree fails to report or withdraw the proper amount, and the IRS identifies the discrepancy through information provided by financial institutions, that can lead to additional taxes and penalties. In certain situations, the penalty calculation can reach thousands of dollars, and combined with other reporting issues, total liability can exceed $10,000. Another key area involves third-party payment platforms and bank transfers. Many retirees now use digital payment systems to receive money from family members, sell small items online, or conduct side activities. Federal reporting requirements have expanded in recent years, meaning that some platforms may issue tax forms when transactions exceed specific thresholds. If a retiree receives funds through such platforms and those funds are not properly categorized or reported, the IRS may treat them as taxable income. If the amounts are significant and no explanation is provided on the tax return, penalties can be assessed. For seniors who already live on fixed incomes, even a few $1,000s in unexpected tax liability can be financially devastating. Retirees who receive Social Security benefits should also understand that while a portion of Social Security income may be tax-free, it can become taxable depending on total combined income. Combined income includes adjusted gross income, non-T-taxable interest, and half of Social Security benefits. If bank deposits suggest income levels higher than what is reported, the IRS may recalculate taxable Social Security amounts. This recalculation can increase tax liability and may result in penalties if underpayment is discovered. Seniors who believe that Social Security is always fully tax-free may be caught off guard when bank activity suggests otherwise. There is also growing attention on foreign accounts and international transfers. Some retirees maintain accounts abroad, receive pensions from another country, or transfer funds internationally. U.S. citizens and residents are subject to reporting requirements for foreign financial accounts that exceed certain thresholds. Failure to report these accounts properly can result in extremely high penalties, including penalties that can easily surpass $10,000. Even unintentional failure to file required information forms can result in significant fines. Retirees who divide time between the United States and another country must be especially careful as international banking activity is closely monitored under federal law. Stimulus payments and other federal benefit programs also intersect with tax reporting. During recent years, federal authorities issued economic impact payments and tax credits designed to support households. In some cases, individuals who did not receive the correct amount claimed credits on their tax returns. If bank records show receipt of payments that were not accurately reflected on the tax return, or if duplicate claims were made, the IRS may issue notices demanding repayment plus penalties. Retirees who changed bank accounts, moved residences, or had joint accounts during stimulus distribution periods may face reconciliation issues if records are incomplete. Another area of risk involves early withdrawals from retirement accounts. While many retirees are past early withdrawal age, some may still face penalties if they access certain accounts improperly. Additionally, incorrect rollovers or transfers between accounts can create taxable events. If funds are withdrawn and not redeposited within the allowed time frame, they may become taxable income. If that income is not properly reported and taxes are not withheld, penalties for underpayment can accumulate. Combined with interest charges, these penalties can grow quickly. The federal tax system relies heavily on information matching. Banks, brokerage firms, pension administrators, and payment platforms send forms directly to the IRS detailing interest income, dividend income, retirement distributions, and certain transactions. When a retiree files a tax return, the IRS compares the return against those records. If discrepancies exist, automated notices are generated. Many seniors are surprised to receive letters indicating unreported income. Often, these notices include proposed tax increases and penalties. If the retiree does not respond promptly or fails to provide documentation, the proposed assessment may become final. It is important to understand that penalties do not always require criminal intent. Civil penalties can be imposed for negligence, substantial understatement of income, or failure to file required forms. For example, if a retiree underreports income by a significant percentage, an accuracy-related penalty may be applied. That penalty is often calculated as a percentage of the underpaid tax. In cases where large sums are involved, the resulting penalty can reach $10,000 or more. This is why accurate record-keeping and full disclosure are essential. Retirees living on fixed incomes must also be aware of estimated tax requirements. If income from pensions, part-time work, or retirement distributions is not subject to sufficient withholding, the IRS may require quarterly estimated tax payments. Failure to pay enough throughout the year can result in underpayment penalties. These penalties may seem small at first, but over time they can accumulate, especially if combined with other reporting errors. Seniors who transition from employment with automatic withholding to retirement income streams without withholding often overlook this requirement. Bank activity that suggests higher income than reported can also affect eligibility for certain benefits. For example, supplemental security income. Eligibility depends on income and resource limits. While regular Social Security retirement benefits are not means tested in the same way, certain state level assistance programs consider total financial resources. Large unexplained deposits may trigger reviews. If benefits are determined to have been paid incorrectly due to inaccurate income reporting, repayment demands can follow. Although this is separate from IRS penalties, it can compound financial strain. Scams and fraud are another serious concern. Some retirees fall victim to schemes that involve transferring money, receiving funds that must be returned, or participating in transactions that later appear suspicious. If large sums move through account of retirees, the bank may report unusual activity. If the retiree is unable to clearly document the source and purpose of the funds, the IRS may question whether income was properly reported. While victims of fraud are not automatically liable for taxes on stolen funds, resolving these situations can be complicated and stressful. The key message is that retirees must treat banking activity with the same seriousness as wage earners treat paychecks. Every deposit, withdrawal, transfer, and distribution can have tax implications. Maintaining organized records, understanding reporting requirements, and ensuring that tax returns accurately reflect all income sources is critical. A $10,000 penalty does not usually arise from a single small mistake. It often results from compounded errors, large discrepancies, or failure to respond to notices in a timely manner.